Good morning. On behalf of the National Community Reinvestment Coalition, I'm honored to join you. You're probably wondering who I am. My name is not on the program anywhere, but that's going to make this morning's conversation a lot more interesting. You see John Taylor, who I'm filling in for. I'm Jim Carr, by the way, NCRC's Chief Operating Officer. John Taylor was caught in the bad weather and won't be here today. So I was asked to fill in for him at the last minute. And so if you notice that my remarks are either particularly provocative or incoherent, it's because I haven't had a chance to read over them. I just find something out. Now, we're starting this morning, and we find out that the moderator has also been delayed. So I'm standing in for the moderator to introduce two people whose bios I am also now reading, although their work and their careers I have followed for many years. So I will do the best job that I can, but I will point out there's yet a third piece of this puzzle that's kind of interesting and intriguing, and that is that we're having a podium malfunction. It doesn't have a base on it. Ah, the moderator has shown up.
So sorry.
So I will only get to mess up part of the program when I fill in for John. At this time, I will turn the program over to Nancy Cleland, who is going to be our moderator.
I'm so sorry, everyone. Blame it on the metro. Okay. I'm sure that Jim carried on very gamely without me. Good morning. You ready for some stimulating talk about the financial crisis and how it creates opportunity for progressive change? That's what we're going to talk about today. I'm Nancy Cleland. I'm the director of the Bailout Analysis Project at API, the Economic Policy Institute. So, just yesterday we launched a series of forums ourselves on the crisis and its aftermath and how it's changing institutions and impacting ordinary people. So, I think we're seeing a blossoming of efforts to counter the influence of Wall Street. And the decisions are being made today that will set the rules for the financial industry for years to come. So it's, in a way, it's about time. Maybe it took a while because we were all in a little bit of shock. And we were all scrambling to understand what happened, along with the Treasury and the Fed and the media, and even many of the financial institutions. But the picture is becoming more clear. Today, this week of action is part of another example of the blossoming that we're seeing. And I think next week, we're going to hear an announcement about a very broad coalition that is seeking a seat at the table on financial reform. So lots happening, and it's really a perfect time to have this panel discussing the issues today. Unfortunately, the opportunity for change is here because the failures of the current financial system are being felt so deeply and so broadly. There's an epic crisis being felt across the country and around the world. We're in the worst recession since World War II. The unemployment rate is approaching 10%, and an extraordinary share of those workers have been jobless for more than 6 months. People are losing their homes at an accelerating rate. I think we just passed the 1 million mark on foreclosures. We know things are going to get worse before they get better. So of course we need to ensure that this never happens again. Today we have an outstanding panel to help put what happened in context, explore some specific proposals for change, and outline ways to build a progressive movement that ensures that the change happens. Our first speaker will be familiar to anyone who's been following this issue for the past 6 months. Simon Johnson is an MIT economist, a fellow at the Peterson Institute, and a former economist at the International Monetary Fund. He leaped into the consciousness of many of us with the publication of an essay in Harper's Magazine that noted the similarities of the US financial system and those of corrupt emerging countries, where an oligarchy controls finance and has an undue influence over the government. Since then, he's become a media star with multiple appearances, Bill Moyers, Terry Gross, other thoughtful, high-profile shows. So Dr. Johnson will frame the picture for us. How did this happen, and how are the various players responding? Jim Carr, who you've already met, I believe, is going to talk about some specific things that can be done. There are proposals that have been out there for years, just waiting for this moment. So he's going to talk about some of them. And then we have Mike Lutz, who's going to talk about how we can use this moment to really set the stage for major progressive change. So I think first we're going to turn it over to Dr. Simon Johnson.
Thanks very much, Nancy. Thanks, everyone, for joining us this morning. So I'll take about 10 minutes to start, and just, as Nancy said, try to frame what's happened, what we've seen, and what the issues are. And I think there are basically two views out there in terms of what happened to the financial system and what has happened to the world economy. There is the official view, which I will call the Treasury view. It's a summary. Obviously, there's various views within Treasury. There's lots of views within the administration, but I think this is the main Treasury view right now. And then there's another view, an alternative view, which I would argue is the right view. Okay. The official view, the Treasury view, is that we had an accident. It was an unfortunate accident, it was a big accident, but it's a very rare accident. If you watch carefully or listen to what Larry Summers says about this issue, and also Tim Geithner, they say it was a once-in-a-century accident. Now, Larry gave a very good speech about this, maybe it's 6 weeks ago, 2 months ago now, which I reviewed on my website, Baseline Scenario. And you can look at my review, you can also look at the Bloomberg video footage. And you can judge for yourself, you can make sure that I'm not exaggerating. But he really did say it's a once-in-a-century, very rare accident. And then he went on to list about 10 other major financial crises, traumas we've had in the last 20, 25 years. The Asian crisis, LTCM, Mexican crisis. You can argue these are all part of one big rolling crisis, or you can argue they're separate crises. The point is, should we really believe, well, the question is, how confident should you be that this is a once-in-a-lifetime, once-in-a-century event? It could be, right? If that's true, then the other summary view that one of my friends attributes to Larry Summers is, there's nothing to see here, move along, go back to your homes. Okay, it's over, right? We're clearing up the accident, and we are taking care of the banking system, we will turn the economy around, don't worry. It might be true, but how confident can we be that that is correct? Right? Given what we've seen, and given all the damage that's been done, I think we should really consider this alternative view, and I think we should actually think of this crisis not as the crisis to end all crises, not as the once in 100 years cleansing of the system or something. Much more like a wake-up call. It tells us what's happened to American society, American politics, and the American economy. And let me summarize that briefly in 3 pieces. First of all, I think the banks, big banks, but also other parts of the financial system, became very powerful politically over the past 30 years. This happened somewhat gradually. There were key moments, and we review this in detail in the article that Nancy alluded to, which is it's in the Atlantic, not Harper's. It's okay. It's in the Atlantic. It's in the May edition of the Atlantic. It's free online, and you can access it through my website, Baseline Scenario. Trying to get you to write that down and go to my website, or you can go straight to the Atlantic website. And in fact, there was a delicious irony earlier this week when I last looked at the online version of this article. JP Morgan is running the big banner ad that appears above my article. So you can either click on my view or the JP Morgan view, and they're kind of different. I like that. So the banks became very powerful. The banks, actually in this country, historically have been fairly constrained. There's been some episodes, I'll talk about that in a minute, where the banks have had a lot of power in the past, but generally this economy, this system, has not been a bank-dominated system, and it's been a political system that's constrained the power of financial interests. Financial interests tend to become big and dangerous in many countries, and this is the link to the emerging market crises, which Nancy mentioned, and which we elaborate on in the Atlantic article. I won't go into detail on that now, but the point is, the idea that the US is exceptional, different, special, I think needs a re-evaluation. We have our own unique features, obviously, so does everyone. But we also have a lot of problems now in common with what we've seen in other countries. Particularly, the financial sector becomes big economically, makes a lot of money, turns that into political access, and gets key decisions, particularly around the regulation of derivatives in the 1990s. during the Clinton administration. It gets those decisions made in its favor, so derivatives are substantially not regulated. Now, that's the background, and that I think explains a lot of how we got into a situation where policymakers and many, or most opinion leaders were convinced the banks could manage the risks they were taking on over the past few years, and of course that turned out to be incorrect. Now, the second point is not just the banks took over, but they're still very powerful. Now, this is a debate we've been having, and as Nancy mentioned, it's been controversial, it's got a lot of attention. And people are still arguing with us about whether there was a moment in January, February, March when major banks could have been taken over in an FDIC type intervention and handled in the same way that you handle small and medium-sized banks. See, this country is very good. I'm speaking as a former chief economist at the IMF. I've worked a lot on crises around the world, 20 years of working hands-on in various capacities with countries getting into trouble. The United States is world-class in handling the bank failure. If we're talking about small and medium-sized banks, people come to the United States to see how the FDIC does it. Okay? We also, I think, in retrospect, did a good job in a very messy situation of cleaning up after the savings and loans debacle in the 1980s. But in terms of handling big banks, we're pretty hopeless. Other countries struggle with this too, I would say, but it is something that really consistently and repeatedly derails growth and causes major economic disruptions around the world when you don't fix the big banks. So in January, February, March, we said do for the big banks what you do for the small and medium-sized banks. And there are many people who said that wasn't feasible, there were other alternatives that needed to be tried first, and there was a very intense debate around that. But what's the situation? And I think that moment is gone. I think we've moved on. I think the government made its call. Treasury prevailed on the stress test. They did a relatively lenient stress test. I think everyone pretty much agrees in retrospect that those were quite lenient. And they let the banks off, if you like, substantially. We can talk about the details, I think, a little bit later, that include the latest compensation caps for banks that are not going to repay their top money anytime soon. But basically the banks prevailed. The next issue, though, very closely related, is regulatory reform. And I think that's a lot of what we're going to talk about here. So if we think that this wasn't just a random accident that happened through some unknown force that we can't define and don't need to worry about going forward, if there was something about the structure of our system and something about the political influence and power of finance, we need to address that, and regulatory reform is a broad, kind of vague heading for what needs to be done. How are we doing on regulatory reform? How are we doing on changes in laws that would adversely impact the profits and the empire building of financial executives, either big or, I would say, small? And I think the answer there is not well. The answer is these lobbies, as I said, have been powerful for a long time, became more powerful during this long boom, and are now, perhaps in January, February, March, were somewhat stunned by the crisis, and I think there was an opportunity there to make more progress. That opportunity, I think, short-term opportunity, has substantially passed. Okay? I think the banks are very powerful in terms of how they're heard in Treasury, how they're heard by Congress, and we can talk about the details in public, and in private I can share even more details on that. As a symbol, only a symbol, but a wonderful symbol, I always follow very carefully the writings and the speeches of Jamie Dimon, the CEO of JP Morgan Chase, because he is so powerful, he's so candid. He has the biggest bank, by the way, the biggest bank left standing. He said to his shareholders, his annual shareholders meeting a couple of weeks ago, "We have had perhaps our finest year ever." The finest year ever? The entire banking system failed. They were rescued. You know, a series of 11th-hour emergency procedures. Sure, they paid back their top money. They had a lot of other forms of government support. They and all other major banks are only still in business because of the largesse of the American taxpayer. Privately held debt to GDP, okay, the amount of national debt outstanding began, before this crisis started, was at 40%. Now, I'm on the CBO's panel of economic advisors. The estimate I'm going to give you is totally unofficial, my private estimate. But the CBO, I think, says that we'll end up with debt to GDP 60 to 70%. I think it's more likely 80 to 90%. We'll double our debt to GDP. That's the cost of what the financial sector got us into. If that sounds too abstract, it's your taxes. Your taxes, your children's taxes, and your grandchildren's taxes will be higher because of what happened. Now, 80, 90% of GDP is not going to derail the American economy, I hope. I mean, subject to certain assumptions, but it's very dangerous. You've used up, that was your get-out-of-jail-free card, okay? That was the safety buffer we were carrying for the rainy day. We just used it. We blew it all, okay? 80-90% of GDP is the kind of debt level that relatively weak European countries, with all due respect, such as Greece or Italy, have. Okay, so we just became Greece or Italy. Great. But did we are we addressing the underlying problem? If we got into this because of a structural change, because of a shift in the politics, and the result has been to incur, through various means, a massive additional debt, are we done? Are we out of the woods? Is it just once in 100 years? You don't have to worry about it? In which case we can pay off the debt over that 100 years? I don't think so. Seems very unlikely, actually. Could happen, seems very unlikely. I think much more likely is we'll do it again, unless and until we fix the system and really change the balance of power here and put finance back in its box. I think, we will talk about specifics, but I think, we should see ourselves as embarking on not a 2-month, 6-month, or 12-month reform process. I think that there'll be stuff, it'll be window dressing, it won't mean very much. I think you should think of this as the beginning of a 5 or 10-year process. And we've done this before in American history. Andrew Jackson had a long struggle against the second bank of the United States in the 1830s. There was a big struggle against industrial trust, not finance. Finance wasn't that powerful politically in the 19th century in the United States. But the industrial trust, the railroad trust, and big oil at the end of the 19th century, that was what the antitrust, the progressive movement at the time, so-called, and the antitrust movement was against. That was a long, hard struggle that eventually prevailed. And of course, the Pecora hearings in the early 1930s, which didn't happen right after the Great Crash. They happened 3 to 4 years after the Great Crash. And they exposed the kind of financial machinations that Wall Street had engaged in. And their 2 big hearings were, funnily enough, the most dramatic hearings with the person, the CEO of National City Bank, which has become Citigroup, and with the head of what has now become JP Morgan Jr., and what's now obviously the last bank standing. So, in a sense, it's the 4th time we've done this in 200 plus years of the American Republic. You just have to do it again. I think the lesson is you have to keep, it goes in long cycles, the sector rises up, powerful, and it's not just about finance, right? It could be powerful industrial interests. They have to be put back in their box, and I think you should do it with a variety, a long list of changes, and I will perhaps come back in after my co-panelists have outlined their pieces. My basic point is, in conclusion, I would say, think of finances like nuclear power. You may or may not like nuclear power. You're probably not going to be able to abolish it. You need the electricity. It's low carbon emissions. But if somebody came to you and said, look, I have this great idea for innovation. You just let me give more incentives to my nuclear power plant operators to take some risk. And they will generate innovation and will get more effective, cheaper electricity. What would you say to that? I think you'd say, no, thanks very much. That sounds really dangerous. And I don't want to have anything to do with high risk in that industry. I want it to be safe. I want it to be boring. I want no accident. I don't even want an accident every 100 years. One accident every 100 years in nuclear power would be a disaster, all right, that we couldn't tolerate. Right? So I think that you should regard finance as here to stay, as useful, as the lifeblood of the economy, absolutely true, and is very dangerous. It's something that can be messed up very easily. It becomes powerful politically. It takes over regulators. Any regulatory body you establish could be potentially captured. I think you need a great deal of redundancy in the system, so if they capture one level, that not all levels fall at the same time. And the most important thing you need is a huge amount, much more transparency and accountability than we've ever had around the financial system. Or they'll tell you it's proprietary information, we can't share that. That has to change. The stress test, I think, at least revealed a bit more information about what these banks are holding on what basis. You need a lot more to be revealed about how the banks operate and what the regulators are doing. So if you have more transparency, more public debate at every one of these levels, we have a chance. And I think we can do it, but it will take 5 to 10 years. Thank you.
Thank you so much, Simon. I love this image of putting the powerful interest back in their box. And I think that's our challenge now, right? So Jim Carr is going to pick it up from there and I think give us some specific examples and talk a little bit further about transparency, accountability, and how we can get the public more involved in these efforts. I believe.
Good morning again. On behalf of the National Community Reinvestment Coalition, we're really honored that you've come to share some time with us this morning for us to share with you our views on financial system modernization. The U.S. financial services sector is in disarray, and despite a recent spate of good news related to improving capital positions and growing earnings, one need only to read the small print in the footnotes to really get a good understanding of the reality that the financial system remains on life support. In many respects, creative accounting has replaced creative finance as the means to present positive earnings news, and just as in the case of creative finance-driven profitability, the newest means of demonstrating earnings is neither sustainable nor desirable. The financial system's collapse was a long time in the making. For the past 30 years, many banks and other financial intermediaries have increasingly sought profits through business practices that were at odds with the financial well-being of the very customers they serve. And over the past decade in particular, abusive, deceptive, and reckless lending practices were the cornerstone of some of the most profitable financial firms in America. The foreclosure crisis is perhaps the most obvious sign of this excessive, unsound lending that became commonplace among too many institutions, but it was far from the only arena of lending abuse. While it's easy to point fingers at the banks, the financial services regulatory infrastructure also contributed to the current crisis. Their oversight of many financial firms was largely non-existent. This lack of accountability has cost families and the U.S. economy dearly. The unemployment rate, as Nancy indicated, is now at 9.4% and climbing. The loss of household wealth has been staggering, measuring into the trillions of dollars. Many have tried to blame the crisis on low and moderate income and minority households. The argument, as many of us are aware, has been made that laws such as the Community Reinvestment Act force banks to lend to unqualified borrowers to promote home ownership. This argument, we all know, is without merit. According to the Federal Reserve Board, only 6% of high-cost loans to low and moderate income households were covered by the Community Reinvestment Act. And according to the Center for Responsible Lending, less than 10% of all subprime loans were to first-time home buyers. This crisis had nothing to do with the benevolent actions of financial institutions going out of their way and making risky products in order to promote home ownership. It had to do with greed and unregulated markets. Now, while many argue that the financial system and the economy are nearing a rebound, that perspective, from my view, is at odds with the circumstances that led to the crisis we have today. A foreclosure crisis is what sank the U.S. economy and the financial system, and that same foreclosure crisis continues today, and it is still growing. Last month, for example, foreclosures were up a full 30% year over year, with more than 1 million foreclosure filings this year alone. And Moody's.com estimates another 5 million foreclosures over the next 3 years, and that's assuming that the latest programs put into place by the administration work exactly as estimated. If we break that down and go to a state level, some state levels have foreclosure statistics that look like the foreclosure crisis is just beginning. So for example, the state of Florida right now is experiencing a foreclosure increase of 75% year over year and 30% month over month relative to last month's data. This crisis is not going away. Now, a lot has to be done. So the first thing that we have to do is really get a grip on the foreclosure crisis. And the plan put forward by the president is superior to any of those programs that have been launched over the last years, making home affordable. It is an extraordinary program in terms of complexity relative to what had been on the table. A number of things it does is, for example, has the government share in the writing down the cost of loans to make them affordable. Loan modifications under that plan actually make the loans affordable and permanently affordable. And what's interesting about this is for months people have been scratching their heads and wondering, why are these loan modifications, the ones that actually are happening, too few are happening, but of the ones that are happening, why do so many people, 40 to 60%, end up going back to foreclosure? And there was lots of speculation that people were being reckless now and going out and spending on credit cards, but we now know as of the end of the year what was happening. Most of the loan modifications weren't reducing the payments. In fact, they were either keeping the payments the same or, strangely, increasing the payments, which flies in the face of the entire concept of a loan modification. The plan the President put on the table also deals with the tricky problem of second liens, which had not been addressed before, and it deals with financial incentives for servicers, and it has other important components. The problem with the plan, however, are twofold. The first is it still doesn't deal significantly with principal balances outstanding. And right now, one of the largest problems with problematic loans is the negative amortization. A second problem is the plan is not directly intended to address loss of income and definitely not unemployment per se. And as a result, we are in this crisis whereby we are assisting households at the thousands, and now with the President's new plan, tens of thousands per month, but we have a foreclosure crisis that's costing us more than 300,000 to 400,000 per month. And so we need to address that crisis. One of the things that we had proposed last year, the National Community Reinvestment Coalition, was a Great Depression era homeowners loan corporation type entity. And we called it Help Now, the Homeowner Emergency Loan Program, whereby at that time we had proposed a reverse auction as a way of getting these toxic assets off the books of financial institutions. As a reverse auction, it would allow much of the cost of taking these loans off the books of financial institutions to be borne by the financial institutions that actually funded these toxic loans, and to use that discount that was gained in the purchase of those loans, apply that directly to the loan modification immediately, not asking the borrower, just apply it. Since that time, we do not believe that a reverse auction would work, and we propose the government use exceptional powers such as eminent domain, because the largest problem that the financial system has is that homes are going to foreclosure, and as they do, they drive house prices down. That drives consumer wealth down. That drives lower productivity, less spending, more unemployment, and we're now in this vicious cycle whereby we must get hold of a foreclosure crisis itself. We also need a program that deals with unemployment-induced foreclosure. We need to get out of the practice whereby foreclosure triggers an eviction of a household, because that doesn't help the family that's being evicted, it doesn't help the community in which they're located, it certainly undermines house prices generally, and it doesn't do the investors any good. And so we need to move forward with a program that somehow deals with unemployment-generated foreclosures, like, for example, converting, perhaps using a moratorium during the unemployment period that's attached to the unemployment benefits of a consumer. To the extent that they don't have unemployment benefits, it might be some type of conversion to a rental program. And in fact, the consumer may actually be allowed to stay in the home so long as they agree to maintain the home without paying anything, simply because a vacant and abandoned property is the worst possible outcome for all parties involved. The second thing we need to do is enhance regulation of the financial system. And as Dr. Johnson pointed out, there are very broad things that need to be done. From the perspective of the National Community Reinvestment Coalition, our principal focus is in two areas. The first is a greatly expanded Community Reinvestment Act, because it is our position that had that law not had so many loopholes, exceptions, and special preferences, opt-outs, and other things, then in fact we wouldn't be in the crisis we have today. And then so in reflecting this, this action today is, our event today is in fact a reflection of a mobilization effort that we are engaged in right now to try and get passage of a greatly expanded Community Reinvestment Act. Specifically, Eddie Bernice Johnson has introduced H.R. 1479, and we would encourage, ask all of you here, as well as those who are listening on the web and other places, to encourage your members of Congress to promote that legislation.
What's the number?
H.R. 1479. And then another thing that was mentioned earlier by Nancy, and I'm very pleased to say that Mike is participating in it as well, is that part of our mobilization action is coming together in a new coalition that will be announced next Tuesday with one of the most diverse groups of consumer organizations I think that have ever worked together. It's extraordinary, from unions to consumer advocates to nonprofits, civic associations, and others to really demand change of the financial system in a way that we really can believe in. Now, the next thing we need to do is enact comprehensive anti-predatory lending legislation, because the reality of what happened in this current crisis is that almost every player in the process, from the broker to the appraiser to the bond rating agencies, the investment banks, the lenders, all the way through played a role in undermining the mortgage market. And new anti-predatory lending laws cannot leave any one of those doors open, not any one of them. And so we are proposing and strongly encouraging the enactment of a comprehensive predatory lending bill, and I can talk about that further in Q&A if you're interested. The third thing I think we really have to focus on is that this current crisis is not an equal opportunity crisis, and that we need to really focus on dedicated attention to rebuilding the communities that have been disproportionately harmed from this crisis. So while we're looking at an unemployment rate, for example, right now of 9.4%, the unemployment rate among African Americans is already 15%. If we had a national unemployment rate of 15%, we would conclude we are in a depression. Well, African Americans are in a depression, and Latinos are hitting there very quickly. Those communities have been hit hard two ways. One, because of the disproportionate impact of the foreclosure crisis, and now the disproportionate impact of unemployment in those neighborhoods. And as a result, the National Community Reinvestment Coalition is promoting, asking for, encouraging funding to communities that have a convergence of three factors. The first is high and exceptionally high levels of unemployment. Second, areas with the greatest concentrations of foreclosures. And third, areas with historically underfunded and inferior or poorly maintained infrastructure. We believe that by focusing on these areas, that type of economic recovery strategy is completely consistent with a macro national economic recovery strategy to create and promote jobs immediately. Because the one thing we know about funding from the bottom up is that it rises up, because the owners of capital benefit every time a low-income person spends $1. And we know for sure that trickle-down doesn't work, or I should say it works just like its name implies. You pour in trillions, and maybe a few $1 bills trickle down. It's time to reverse that formula. In conclusion, this is a critical moment in history. It is a moment that cannot be allowed to be lost. It's often said a crisis is a terrible thing to waste. It's not just a slogan, it's a fact. If we can't turn around the conditions that we are facing now in the middle of this crisis, the likelihood that there will be the political energy to turn it around once the crisis is felt to be gone will not happen. Failure to demand accountability from the financial system and its regulators that led directly to the crisis we have today would be a failure on our part. We must not let the reality of today's circumstance fade as the crisis seems to be going away. Millions of Americans have lost their homes, they've lost their retirement, they've lost their savings, they've lost their financial security, and most importantly, they've lost their dreams for a better future. Let's make sure we do our part to ensure that this does not become the 100-year flood event, that this never happens again. Thank you.
Thanks very much, Jim. And Jim mentioned a number of specific initiatives, and I think if you want more details, you can probably find them on their website, which is ncrc.org. So I think that was a perfect setup for our next speaker, Mike Lutz, who is the co-founder and president of Progressive Strategies, a political consulting firm that was founded in 1999. And he is the author of a recently released book called The Progressive Revolution: How the Best in America Came to Be. The book looks at a history of conflict between progressives and conservatives, and how sometimes these conflicts create opportunities for major change. I think he calls them the big change moments. And so we're hoping that we are in a big change moment right now, and I think Mike's going to tell us a little bit about how we can take advantage of it.
Thank you very much. It's great to be here with these distinguished gentlemen. I want to start out by saying this. I am more of a politics and history guy than a policy guy. But you don't have to be as brilliant as Dr. Johnson or the folks at NCRC to understand the common sense around what they're talking about. If you're too big to fail, you're too big to exist. If by some institutions in private hands becoming so big and so powerful that they dominate our economy in such a way that these Wall Street firms do, that they dominate our politics in such a way that these Wall Street firms do, they need to be taken down a notch politically, and they need to be taken down in size in general. And that's just common sense. You can't have a functioning democracy if you have some institutions that are so powerful that they can destroy everything in their wake if they do stupid, greedy things. And that should be a basic rule going forward as we work on this issue. I want to just sort of start by talking about the power of these Wall Street firms and compare it to so the power of other institutions going forward. I did write the book that Nancy talked about, The Progressive Revolution, and these banking issues, as Simon said, go way back. In fact, I take it back even further than Andy Jackson. I take it back to the fight between Alexander Hamilton and Thomas Jefferson over how much power to invest in the big banks back in the 1790s. This fight has literally been with us all through our history, and we're going another round. But what's happened in recent years, as the political and economic climate has shifted, is that the banks, these big banks, the big banking institutions, have grown more and more powerful. I have spent my career working on issues, both, I was in the Clinton White House, but in general in progressive politics and progressive movements, and fighting the health insurance companies and the big pharmaceutical companies, fighting big oil on environmental issues, fighting with some of the big right-wing groups like the NRA and the Christian Coalition back in its heyday. And these are powerful, powerful institutions, and we're fighting all of them to this day. But I have been stunned with the incredible power that the banks have amassed. They give to both parties. They give huge amounts of money to both parties. They control so much of the media, as well as things that go on in D.C. So working to bring down their power and to bring down their economic cloud is going to be a long haul. As one of our favorites, Donald Rumsfeld once said about something else, it's going to be a long slog. We have to take advantage of this moment. I think we can take advantage of this moment, and I'll talk about that in a minute. But we also have to think in terms of this being a multi-year fight. I very much agree with Simon on that, because these institutions have so much ability to influence so many different things. I think what we have to do is a multi-part strategy. First of all, I want to make this comment. It's not directly relevant to this issue, but I think it's important to say, and not just because I care about these other issues too. In order for the Obama administration to be successful in general, they are going to have to beat these big corporate lobbies. They're going to have to beat the insurance companies and the pharmaceutical companies on the healthcare reform fight. They're going to have to beat the energy companies on the climate change fight. On a whole series of fights, they're going to have to take on specific interests and beat them. And every time they are successful in doing that, it makes the next change easier. That's one of the things I talk about in my book, is that when you have a window open, that is a sort of a window opens for an opportunity for change. If you open it wider, you allow more things to happen. You build on the success. The fact that FDR had early success allowed him to, a couple years later, get Social Security and a minimum wage passed. The fact that Abraham Lincoln was successful at building a coalition to prosecute the war allowed the Republicans to do a whole series of things, not just during the war, but in the immediate years afterwards, that moved progressive politics forward. The fact that Teddy Roosevelt was successful in some of his fights against corporate trusts and the food companies allowed him to be successful at other things. And so I think as a progressive movement, we need to support each other on all these fights. You don't fight an issue like what we're talking about, which is so big and matters to so many people, in isolation. You fight it in context. And so I think that's an important point that I want to make. The second thing in the strategy going forward is, I think people need to get over the idea that there is a White House position. The White House, any White House is like this. Democrats are even more like this than Republicans. There are a variety of opinions inside the White House on these issues. There are a variety of opinions on strategies around how to go forward on these issues. And the opinions shift from week to week, sometimes even day to day, depending upon new facts that come in. And President Obama, unlike, I think, our previous president, actually changes his mind depending on new facts. I mean, if something is happening that is different than what was predicted, he'll pay attention to that. And I think right now, I mean, I see a White House evolving, and I was on the transition, and I still talk to my friends in the Obama White House all the time. And what I see is that there are a lot more people getting engaged in the banking issues, a lot more people getting engaged in the regulatory fight, including some very good, strong, progressive people who have their ear to the ground in terms of what the public is thinking, who are willing to work with the kinds of organizations that are represented in this room. So I'm actually somewhat encouraged by the fact that there is that internal tension in the White House, and the fact that we have a chance, I think, to support our allies in the White House by giving them additional facts and information and research to buttress their case going forward. So I don't believe that we should be discouraged when we see something floated in the paper as if it's a fact. I think that this White House is very open to new ideas and very open to hearing people out, and they are not, as they did earlier this year when Simon was talking about, they had a chance this spring to make major change in terms of this issue, and they chose not to do it. But I think as we go forward, they're going to be reevaluating this on a really constant basis, and so I'm hopeful that we have the ability to work with them. Second thing I would say is we need to think of this in a very much of building a grassroots movement and tapping into the anger that's out there. I don't think you can win this in Washington. I don't think you can win this doing traditional lobbying methods, traditional inside the Beltway methods. I think you're going to have to get out into America, and I think when you really talk this through with people and you explain it in common sense kind of terms, I think that the American people are with us on this, and that over time is going to drive this debate. And I think we can be successful if we do that. But it's going to take more than the traditional interest groups doing the traditional policy papers and the traditional things in Washington. I think we're going to have to be very creative. I think we're going to have to be very aggressive in getting out, doing the kinds of events that A New Way Forward has been sponsoring, and other groups. I think we're going to have to use online organizing, online communications in a very aggressive kind of way because these banks are so powerful. So let me just wrap up again with this point, and then let's open it up for questions. Because I know a lot of you will have really interesting comments and questions. This is a long fight, and we have to seize the moment. I don't think those two things are contradictory. I think that we have an opportunity over the next couple of years to change American politics, to take on some of these big interests, to go directly at them and beat them. I wrote a post yesterday in the Huffington Post where I basically said that on the health insurance issue, that I believe that we have the ability, if we are aggressive and tough over the next few weeks, to literally take down, to roll the insurance industry. They don't want a public option on the health plan. I think we have the ability to beat them on that issue. I think we have the ability to really go at the energy industry the way it's structured and to change it. And I think we have the ability to use this moment to take on the banks. We aren't going to get everything we want in this regulatory fight, but I do think that we have the ability to drive a lot of good change. I'm actually encouraged by what I'm hearing from friends in the White House and friends on Capitol Hill about some openness to ideas that folks in power have not been open to for a while. So I think we've got the ability to make some good change. But that the change that we make over the next few months is just the first step. We have to look at this as a long-haul battle, because powerful folks are in part powerful because they have deep roots in Washington. They are not going to go away. If we win on one aspect of the regulatory fight this fall or early next year, they're going to come back at us. If we pass good legislation, they'll try to undermine it. It happens over and over and over again. You see it in fight after fight. Whenever they lose, they come back stronger the next year. So we're going to have to build a permanent movement to keep working on this issue and to keep this change going. Thank you.
So thank you very much, Mike. Great discussion. It is getting kind of late. I think I'll take the moderator's prerogative and ask one question, and then we're going to open it up to the crowd. And this is something I heard from all three of you and have heard from many people throughout, that the banks are too powerful, they're too big, they're too complex. We were talking with a group of small bankers, community bankers yesterday, who feel the same way. And in their view, there's no reason why the big banks could not have been taken down during this crisis, but they weren't. So I'm just wondering if you, if the three of you think that they can be broken up, and is that something that we should pursue immediately, or is it better to take more incremental steps?
Should we stand?
I think from here on we'll just sit.
So I think that's a good question, and I think the answer is they can be downsized. I think the opportunity to determine that they were insolvent and to take them over in an FDIC type process, I think that moment has passed. But if you look, for example, at the rules that remain for, and I was actually opposed to the banks being able to pay back their TARP money, because it creates the impression that somehow, well, the deadline is we didn't need the money, we never wanted it, and we've just given it back to you, now we can do business, go back to business as usual. That's very dangerous. Okay, so all the guys who got free from any idea of restriction around their compensation, I think, should be regarded as dangerous escapees more than anything else. But remember that Bank of America and Citigroup and some other major institutions remain within the TARP and remain, it seems that their compensation is going to be limited. And if you are constraining how much they can pay their people, you are going to be reducing their ability to attract people, and you're going to be pushing them to downsize. I think that that's one very practical mechanism. We'll see, I mean, this speaks to Mike's point, we don't know how the special administrator of that scheme is going to operate, and there's a lot of devil in the details here. But that's one way forward. I think the use of antitrust, not something we had a chance to talk about yet, is also plausible in some contexts. Jamie Dimon is excited because his market share has gone up. Well, we have rules about market share, we have rules about pricing power that you could use to apply. Bear Stearns and Lehman are gone, right? And the Department of Justice needs to look at the implications in using conventional mechanisms and perhaps extending their frameworks, thinking about antitrust. And I think the use of a kind of a Consumer Financial Products Commission, the idea that Elizabeth Warren's been pushing for a long time, in this context as part of a broad package of ways forward makes a lot of sense. I think that will impact the community banks as well as the big banks, and I don't want the community banks to feel that somehow they are immune from all the concerns we're raising. But I think this package's broad approach can still have a substantial impact. But as Mike says, it's a long haul.
You know, I agree with everything that Simon said. I would add one point of context. I was in a meeting on the financial issues at the White House yesterday, and I said, look, I think the number one goal for you all going forward is to reduce the economic and the political power of these banks. Whatever else happens, however else you structure things, that should be the number one goal. And I was kind of amazed. Nobody laughed me out of the room. There was a positive reaction. So I think there are at least some folks in the White House who are open to that idea, open to some of the ideas that Simon was just talking about in terms of policy. I think that one of the things that needs to happen, frankly, is that this big new coalition that's coming together needs to spend some time focusing on these issues. I think everybody's got great ideas about specific regulations and sort of regulatory reforms, but I don't think we've spent enough time talking about, okay, if there is really a serious opportunity to downsize some of these banking institutions, how exactly would we do it? Would we do it through antitrust? Would we do it through XYZ regulation? So I think there needs to be, I think that's a weakness on our side, frankly, in terms of the how-tos. And I think we need to spend more time on that.
Could I just ask, Mike, does the White House feel they have made any progress against the economic and political power of banks so far since they came in?
Well, again, there is no White House. There is like all these competing parts of the White House. The folks that I was talking to don't.
Sure. So the National Community Reinvestment Coalition does not have an official position on too big to fail. So these are really my opinions, unless they happen to hear them and decide they love them, or unless someone attributes them to me and Congress work goes out and enacts them, at which point they will be ours. So the idea of, and Mike had alluded to this, of a financial institution that is so large that it can undermine the entire financial system just seems to be a curious idea, particularly in an environment where there's so much conversation and talk about a systemic risk regulator. It seems so contradictory that on the one hand you try and figure out what that regulator's powers need to be, how they should be structured, where they should be located. At the same time you leave the biggest risk to the financial system in place. So it just begs the question, why? The second thing is that, well, if you are going to leave institutions in place that could potentially bring down the entire financial system if they misbehave, then it begs the question, are they providing things that smaller financial institutions can't? And as of this point, I'm not aware of, perhaps others may know, but I'm not aware of any empirical data that suggests that the extraordinary sized institutions are bringing a value to the financial system that cannot and is not being provided by smaller institutions that would not be too big to fail. And so I would suggest throw that out as a challenge to those institutions as that debate is about to begin. And then the third is, if regulators and legislators decide that financial institutions that are too big to fail should exist, then it seems that if they are going to put the American taxpayer at such extraordinary risk, that the American taxpayer should get an extraordinary benefit. What I mean by that is, for example, there are 10 million households who are unbanked, and as many as 40 million who have very tenuous relationships to financial services institutions. So maybe one of the things that might be required in return for the federal taxpayers' guarantee and insurance is that large institutions that are deemed to be too big to fail should provide financial products and services to certain types of consumers at cost, meaning no profit, not low profit, no profit. Because at the end of the day, when you look and see what's happened in this current environment, it's those very consumers who are actually being damaged the most by the reckless behavior of the financial institutions that brought the financial markets down and the economy. Financially vulnerable communities and households are always going to be the first to suffer and the worst to suffer through the collapse of the economy.
Let me just do a quick response. I think politically it's dangerous to let these banks that are too big to fail continue to exist, and the last idea is the one I'm reacting to. And in exchange, we'll let you exist, but you have to give some good things out, to poor people. Because what tends to happen is that their political power, if they're that big, they're not only a power economically, they're a power politically. And if they're that big, you put some regulation like that in, 2 years later they'll come back, take it away. The National Association of Broadcasters has proven that by taking it. There used to be all kinds of access for poor people to do community programming or children, do more things for children. Broadcasters have taken away all those regulations over the years.
Can I see your response in ratio 1? Just real quickly. I want to be clear that what I meant was in order, so I completely, mostly agree with what you said. What I was saying was if we can empirically document that those institutions provide a benefit to the American public that supersedes the risk that they present, then we might leave them in place. But the general concept, I'm completely in agreement with you. I don't think that there's any data to prove that.
Okay, do we have a mic for the questions? Okay, well, let's go with you first, sir.
My name's Ron Fisher. I'm a retired Navy captain. I have a tremendous amount of experience with this. I was a Duke submariner and I managed overhauls. And I'll tell you that the overhauls we managed were way tougher problems. They're way tougher. That worked around the regular. Anyway, my main question is we should consider a plan. We always had big plans in the Navy. For example, one of the things that I'd ask you to consider is that those banks should have been seized. They're insolvent. Citigroup and American Bank should have been seized. The FDIC and the regulators are wrong in not doing that. They should be seized and operated as government-operated, government-owned, contractor-operated. And then you can enforce these rules. And there's a whole bunch of other things to do. Limit interest rates to 6%. Outlaw derivatives. These things are all here. The other thing is 2 plans. One is putting America to work. We need 20 million jobs and 1 billion jobs worldwide. Jobs are really important. The stimulus package could have ramped us up to 20 million jobs in 9 months. I did work loading in the shipyards in particular. And we need to get people in charge of them that are really interested in banking. If you seize them, operate them that way, lay off all, throw out all the leadership, keep the people working, just like at White House City. Those banks would work and then break them up. Anyway, that's my plan. And what I'd like to do is give you a copy of it. And obviously it's too late to go over here. If you want to talk about it or see me afterwards, please do.
Okay, thank you very much. Yes, sir.
I'd like to pick up on Jim's point about the race and ethnic dimensions of this problem. I spent the last 2 days at the Urban Institute with a collection of fair housing lawyers and activists. And when the CRA came up, they expressed some concern that the CRA and what they viewed as other place-based remedies flew in the face of what they see as their priority of helping people move to so-called opportunity neighborhoods. Now, I made a strong pitch that the CRA and CRA Modernization Act could be a very strong pro-integrative tool. I argue there's empirical evidence for this that I published. They apologized for not bringing Jim Carr to this meeting, but I see sort of an area of disagreement among 2 groups that are in agreement on something like 99.9% of the issues. But particularly in light of your discussion of coalition building, somehow, and one of the people at this meeting has said to me previously that the Community Reinvestment Act is the federal government's largest, most expensive resegregation program in the history of the country. The concern being that it encourages people to buy homes in low-income neighborhoods, and what we need to do is help people move to opportunity neighborhoods. How do you cross that bridge?
Very easily. I find an argument that somehow is one or the other to be just a unreasonable and unnecessary discussion. It's both and. The distress that we see in communities of color has been a pie that has been baked for the last century. The levels of high segregation that we view in America did not exist 100 years ago. I think it's really important to understand that. It was public policy intentionally to create segregated neighborhoods that destroyed and undermined the economic potential for communities. But it goes beyond that, because a lot of people say, well, just because blacks or Latinos live segregated, why is it that their neighborhoods are in such bad shape? It was because, one, they didn't have the opportunity to move to communities of opportunity. But at the same time, even within their communities, they couldn't access financial services. So they couldn't build their own prosperity within their segregated neighborhoods, nor could they move. This is why I say to me, it's a superfluous conversation of one or the other. It's both. Communities, the law should enforce fair housing laws so that people can live wherever they choose. And if they happen to choose to live in a black or Latino or Asian or other neighborhood, and or they can't afford to move, because not everyone can afford to move who would like to live somewhere else, they have access to the same efficient, low-cost financial services that millions of Americans do. So it's not an either or, it's a both and. And I think when we get into those debates, we really undermine our own efforts.
I'd like to just expand on that a little bit and ask Mike what he thinks about how do you build a coalition around a big idea, as you were saying, and keep it together despite differences on the specific areas, such as the one that was just mentioned.
I don't believe that there's any general theory about something like that. I think it's literally a matter on each of these issues of working through the details and doing it from a good faith perspective. You know, healthcare is an issue that I've spent a great deal of time on in the Clinton White House. I was in the war room, and I've helped put together Healthcare for America Now, which is the big coalition that's leading the fight to pass the Obama plan. And there are lots of policy disagreements among the groups on specific measures, but what you do is you agree in advance that you're going to work together on the general principles, and then you work through those debates. And sometimes you have to agree to disagree, but mostly what I find is that people of good faith who share the same values and the same goals come together, they can work through the details in a fair kind of way. If you can't do it, obviously you'll agree to disagree on those issues, but then keep working on the rest of the issues as you go forward. But there's no sort of general formula. You just have to do the hard work of sitting down with each other.
We have someone here.
Hi, Josh Silver, NCRC. Greg, that was an excellent question. Quickly to respond to that, CRA is currently constituted, gives banks points for lending in low and moderate income neighborhoods, but also gives banks points for lending to low and moderate income people in middle and upper income neighborhoods. So it's a very pro-integrated law. But anyway, I wanted to mention that for the rest of the audience. Number two, I think the antitrust issue is a very important issue to think through. Right now, as Simon Johnson knows and Jim knows, that if you have more than 10% of the deposits across the country, you are not allowed to merge or acquire another bank. And guess which institutions have 10% of the deposits across the country? Bank of America. Guess who is probably going to lobby to raise the cap so they can merge in future years? And that's the political power that the big banks that we're talking about. should they be revised? I think they should be revised downward. And also, since banks and insurance companies and securities firms are now all be in each other's business, thanks to Graham Wiley, should we have different measures of antitrust? I think deposits probably is antiquated. Let's look at their market in securities or insurance, and that also begs the need for additional data and transparency. So this is an antitrust question, and any thoughts about these quantitative thresholds and whether they're archaic?
Simon, I think I just saw something yesterday that Bank of America has 19% of all assets.
Yeah, they got a waiver. They got a waiver on that rule. And I think that I think first of all the rules should be enforced, and I think Bank of America is an issue there. I think that I'm sure you're right that these are antiquated. We have lots of antiquated rules, and these are among them. I would emphasize something, building on what Mike said a moment ago, which is this: if you think you have big banks right now in the United States, just don't do anything, wait around and see what happens. In many European countries, they have banks relative to the size of the economy that 10 times our banks. And if the strategy which you have is anytime a bank gets in trouble, you merge it with some other banks, this is what happens. Royal Bank of Scotland, largest bank in the UK, peaked at 2 times UK GDP. Right? Our biggest banks peaked around total balance sheet, 20% of US GDP, and that's big enough to be a problem. That's big enough to create these worries.
And what happened to that bank?
Well, it's been taken over, and it's become a huge fiscal liability to the British state, and it's going to be that's a 10-year mess, a different kind of mess to extricate themselves from. We just don't want to go there. And I think we should look at this from an antitrust perspective. We should look at it from a regulatory perspective. So if you can't find, we can rewrite our antitrust laws for one thing, all right, change the criteria. But if that route doesn't work, then I think this issue of defining what is too big to fail. Any of the 19 institutions that went through the stress test were implicitly too big to fail. That's why they did the stress test on them. Right? You can draw that line at total assets, and you can say that if you're above that level, you face much tighter limits on executive and other compensation because you have the capacity to generate a level of system risk that is not likely to come out of community banks, for example. So I think we should pursue this across the board, and I think this fits with what Mike and Jim are saying, which is build a coalition, work out some common ground. If you won't agree on absolutely everything, you don't need to. I mean, there's a list of 10 or 20 things that are worth pursuing. If you can get 5 or 8 of them enacted in the next 5 years, it's a step in the right direction. Right now we've got 0.
Chris White with PwC Capital Markets Group. I have a 2-part question. It's just for those of us that prefer to work with our hands, we're not smart enough to participate really in the public policy debate at a more intellectual level. Can you guys cite some proposals that are out in circulation regarding parallel institutions that can compete with things like central banks or payment systems that are based more on philosophy of John Rawls and on utilitarianism? Also, can you guys point out any sort of modern versions of sort of Solvency-like direct action that can be taken against a lot of these financial institutions? So perhaps something along the lines of coordinated deposit withdrawals from banks that are misbehaving. You get a group of people together and everyone on a given day yanks their money out of the bank and kind of screws over their ratio cap.
Well, let me address at least part of the question, and would be interested, especially on the first part of your question, what my 2 policy experts on either side of me have to say. I do think that there are a variety of more community-based financial institutions that are possible, and I am. I think, for example, savings and loans and cooperative financial institutions, I think, are really interesting models to explore. And I'm a big believer that progressive-minded people should work together. We need to get out of this idea that the only thing we know how to do is run nonprofits. We should create cooperative ventures that really do work for people in their community that are community based and community controlled. I really am a big believer in that. There are, in terms of the last part of your question, there are a lot of great community organizations out there that are actually already working on banking issues, doing some very creative organizing tactics around the country. And in fact, the group that Alinsky founded, Industrial Areas Foundation, is one of them. They keep on in his spirit, but National People's Action, Gamaliel Foundation, which is a church-based community organizing institute, a number of others. Acorn has been real involved in foreclosure issues and some of the different banking issues. So there's a lot of different organizations that are doing good work, and some of it is very sort of basic community organizing, just like getting in the face of. I mean, there was one group in Connecticut that did a tour of AIG executives' homes. Came and sort of showed up at their homes and showed people the yards and the manors and the guest homes and so there's been some actions like that have been good, and I just think that we need to be, as I said, creative and aggressive in all of this.
I would just build on to, well, just to be quick, I want to just build on to one point that Mike made at the end. Talking about individual actions, individual institutions, I think it's important for us to recognize that this is a system-wide problem. And so while some activities against a lender might be appropriate because of some particular misbehavior in which they were engaged might be good, the fact of the matter is we need to hold elected officials accountable, because at the end of the day, it's up to them to put into place a system that protects and supports the American public. We don't have that now. And no matter of intervention aiming at a single institution at a time is going to get us there. We need to hold them accountable first to enact the laws that need to be on the books, and second of all, to require that the regulators actually enforce them. And we don't have that now. And that is one of the main things that we are trying to do at NCRC with our mobilization efforts, bring about accountability through the whole system.
So just to add to all of those good points, it's amazing that everybody throws up their hands and says we have no power, we're so frustrated. Who owns these banks? The banks are publicly held. They're held by us, usually through mutual funds or insurance companies or pension funds. Okay, there's a level of indirect. And how do we do as shareholders? We've done very badly. They destroyed mass amount of shareholder value. These banks, focus on this, these banks are run for the benefit of the insiders, for the people who control the banks, right? And having shareholders, passing legislation so the shareholders would have to say yes on excessive compensation or large compensation. You actually have to have the shareholders agree, opt in rather than opt out. That's an idea that this White House should be able to get on board with.
Could I respond to that, please? Thank you. Ed Gorman, I'm American Community Partnerships and NCRC board member. The problem with that argument, Simon, it's a great one, but it lacks the regulatory underpinnings that allow shareholders to actually exercise their rights. Proxy fights are so narrowly focused and so difficult to sustain. And as a guy, I was counsel for Carpenters International, and one of the best practitioners in the country on the issue of proxy shareholder fights is in the Carpenters, guy named Durkin. The Teamsters, a number of other unions have done a great job trying to make the case, especially on executive compensation, which they've been doing for over 20 years now. And that issue is finally coming into the public focus, but only after an economic tsunami. I mean, the problem is without a legitimate shareholder bill of rights, in which the voice of shareholders is expressed by more than just the narrow bounds of, have we framed our issue right? Have we nailed it properly? Have we set it up so that there's a fair comment period? I mean, it's just a very difficult thing. So if you want that kind of change, you really do need to suggest, I think, a broader shareholder bill of rights. May I follow up on one other thing? The issue of community-based banking, I think, is something that the community banks themselves don't yet understand. Chris Petrie is with us here today as an intern with us. Went to a meeting yesterday. A lot of things happened yesterday in Washington. And the community banks are yelling about the federal government's role in intervening in their activities, giving them money that they didn't really want to get, and generally complaining about the federal role here. So in provide more opportunity for community banks to be place-based focused. And by the way, I think the Obama administration gets that too. There's a place-based focus that's coming out, I think, in the next 2 weeks. I heard yesterday at OMB. So folks who don't believe place is important are going to be sorely disappointed, I think, by that initiative. Long story short, I think community banks and an overarching principle that we've got to treat the problem where it exists instead of trying to move people to other places where it doesn't exist. Ultimately, I think that's important.
All right, we're going to have to limit it to 2 more questions. I know you've had your hand up for quite a while.
Yeah, I've Megan Siebert with the Huffington Post and American News Project. I've got a question for Mr. Johnson. You've talked a lot about financial oligarchy and the need for a broad popular support if there is going to be regulatory reform. I'm wondering, within that context, how important is it the issue of having indictments of people at, I guess, the upper levels of some of these financial firms? There's been a lot of indictments of people at the lower level working in the subprime industry, things like that, but there's been relatively few up until, I guess, this week with Countrywide. But how important is it to see more of that in your mind?
Obviously, you need to find out who broke the rules, and you need to pursue them through all appropriate legal means. And if there were illegal acts, hopefully there will be criminal prosecutions. I have no reason to think the Department of Justice will shirk from that at all. I think all the indications are they're taking this very seriously. Take the time to do all these cases. And the problem is, the big problem is, there are many things that were done that were unethical, irresponsible, and extremely damaging to the country that were probably not illegal. So we need to change the laws to make sure that that can't happen again.
I also think there's a huge role for investigative journalism, as American News Services is working on. That I think that journalists digging into the books, digging into what's going on with these financial institutions and why some of these deals got done, I think is an incredibly important thing, would be an incredible public service.
Oh my God. Okay. There are 2 very insistent people. Can we make it very, very fast? You?
Yeah, I'm Jim Byrne. I'm covering this both for NCRC and for Community Development Digest. Could you, Jim, give us a kind of a quick political outlook on the chances for the CIA Reform Act? Bernie Johnson is not a member of the committee. Barney Frank was not a co-sponsor of that bill. He may be now, I don't know. And Frank and all those people took bank monies forever and ever and ever, so I'm not great optimist about their health.
Okay.
So the coalition that we talked about that's being put together next week is going to bring, to Mike's point, an extraordinary collection of institutions together, and CRA modernization is a major priority for that group. In addition to NCRC's own CRA campaign, a campaign that we're leading, we feel very confident about it because we believe that the American public deserves better than it's gotten, and we believe our challenge is really just helping the public understand what happened, and we believe we'll be successful in doing that. And when we do, we believe that the political forces will come to the table and recognize this is in the best interest of America. So we're very optimistic.
Okay, final question here.
If the banks are too big to exist, why not do organized runs on the banks and bring them down?
Yeah, I don't think that's a good idea. I think you ought to be very careful that you don't take actions that are damaging to the, as Jim said, the more vulnerable people, the people with less money, the people who will be the last to hear of what's going on. I think it's very important that we act together. I think that you've heard some very sensible general strategy and specific recommendations that will make a difference. It takes time, and you have to have patience, and you have to keep at it.
Okay, thank you very much to our distinguished panelists. Look for Simon Johnson on baseline-scenario.com, ncrc.org for all your information on CRA modernization, and definitely read The Progressive Revolution. Buy it and read it. Yeah. Thank you so much.